Thank you so much for joining me on the show today. Egie, I'd just like to get a sense of what you've made of the activities in the past 48 hours in the markets.
Well, I think it's obviously a big sell-off of probably, I'm not sure I've seen this magnitude and speed across multiple markets before, but clearly there's a lot of panic activity, and that's the reason why you're seeing such big drops in valuations.
Yes, but when you look back at the events of 2016, just before we had the Naira devaluation, we're looking at how oil prices were also affected in the build-up to from 2014, 2015. Would you say it's similar, or might we see getting, like you said, you've not seen this much before? Are we going to see that impact on the Naira even worse than what we saw in 2015?
Well, I think the difference here is that the 2015-16 problem was largely a Nigeria problem. Yes, oil price slid down, but it was gradual. You didn't have something dropping 30% in one day. Also, you didn't have a collapse in equity markets in advanced economies happening at the same time. Normally, that drop in oil price was actually positive to economies like the US because they put more purchasing power in the hands of consumers. So whereas here you're seeing huge drops of the entire index sectors being pretty much capitulating, and you didn't have that. So it's a global coordinated drop rather than being isolated to countries like Nigeria or producing countries.
But what would you say is the attitude of investors right now? If it's a flight to safety, they're looking at the riskier markets and leaving them and going to more safer places?
Well, I mean, if you look at what happened to the US bond yields, I mean, clearly when they went to record lows 2 days ago, clearly it's a flight to safety. The situation in Nigeria is a bit different because it depends on what currency you're investing in. If you're a foreign portfolio investor, you just want to get out while you can still get your foreign currency, whatever you can get. Because, if you wait too long, you're going to be hit by a big devaluation. If you're a Naira investor, it's a slightly different situation because you have to project, okay, if you're selling your stock at 11 Naira, what are the odds that it gets to 22 Naira before the Naira gets to 720? Probably will get to 22 Naira before Naira gets to 720. So you don't, particularly if you don't have an option of converting. There are a number of local investors who don't have the option of selling and converting their currency. Their decisions are a bit different from the foreign portfolio investor whose base currency is foreign currency.
Yeah, but looking at all of this, it speaks to how vulnerable our economy is and how vulnerable we are to shocks like this. Looking at you would think that we have learned the lessons from around 2015 era when we saw events like this take place. But what I'd like you to speak to that point, how vulnerable we are to this kind of shocks.
Well, I think, obviously, if you rely on foreign investors, you will hope that your own economy is slightly differently correlated from theirs. But now you have a situation where everybody is panicking at the same time, both the foreign investors you're relying on and in your own economy. So I wouldn't say we are much better off, particularly because a couple of events that were supposed to happen did not happen in time. Take, for instance, Eurobond issuance. Ghana issued a Eurobond last month, 3 billion. We're going to issue 3.3. I don't know if that can happen right now. If that had already happened, then there might be a bit more wiggle room, buying a bit more time. But clearly the structural changes have really not happened. So we're probably in worse shape now than then because of much larger public spending and much larger debt load.
Yeah, because when you look at the downgrades that we've had recently from the rating agencies, that would also impact our showing in the Eurobond market.
Certainly, and when you look at secondary prices of Nigerian Eurobonds and corporate Eurobonds, they've moved very rapidly in the past few days, right from Monday. So clearly, it'll be hard to sell anything right now at sensible rates, particularly since they like to go very long term, 20, 30 years plus. To do that now, you're paying double digits.
Yeah, so let's look at the impact on the bond market, on the T-bills. How much similar or different is it so far, the impact we're seeing?
Well, so the difference here is that whereas if you look at the US market, they went to record low yields. Here, yields are moving up. They're not moving down, right? You think that people are selling out of equities going to fixed income, and that should depress yields. But again, slightly different here, simply because, again, the foreign investor who is in that market is selling to get out at any price, and then the local investor knows that a dislocation is going on because you have very wide bid-ask spread. So a lot of people are just waiting, standing aside. But clearly, yields are going up, fixed deposit rates are going up, bond yields have gone up, and the spreads are so wide that you know that the buyers are just waiting for the sellers to give up and sell at a new level.
All right, but very quickly now, looking at what has happened with the ECB today, looking at the same issues facing them, but then they held rates and then they announced like a stimulus. Are we likely to see something similar from the central bank, or do you think we should have like an emergency meeting before the MPC meeting coming up in a couple of days?
Well, I mean, again, if you look at what the U.S. Federal Reserve did, the 50 basis points cut, like I think it was a bit over a week ago. I mean, in a situation this serious, I will think that you call an emergency meeting and not wait for your program meeting. But again, I don't have all the information they have. But the situation is not business as usual, so I would have expected earlier intervention rather than waiting for the calendar.